Okay, good evening, everyone. Welcome to the Hurley Investments Market View commentary for, it's actually the second today, for May 2nd, 2022. I've got a bunch of different directions that I want to go off on. So please give me, I'm going to be a little sporadic is all I'm going to tell you today. So what I'm going to ask is, what can you tell me now that we are done with April? Right? What can you tell me now that we're done with April? Because I've got a couple things. Yeah. So thank you. You know, Peter, I'm going to appreciate that one. You said there would be some tech selling, and there was some and more, right? I agree. You know, we had some tax selling, and let's face it, the bottom fell out last week. What else can you tell me? Thinking technically, but what else can you tell me about April? I like it. Possible double bottom with the market being down 15 to 16%. Of course. I like it. What else can you tell me? I'm asking you these questions because I want you to be involved in your portfolio. I want you to think about what's going on each week. I want you to know that we're looking at what's going on each week. But what else can you tell me? What else can you tell me about April? There you go. Horrible month for technology. And if I can just add in there, I'm just going to put in the Nasdaq, right? Is that okay? Dave, is that okay if I just put that in there? Perfect. Yep. Okay. Anything else you guys want to say? I'm waiting for Kohler to tell me Title 42. That's one of Jim's favorites, mine too. What else can you guys tell me? So, you know, that, Mary, that's interesting. So I'm going to rephrase, because you put a whole bunch into that paragraph. I'm going to rephrase it. You tell me what you think. It seems like the market was down while individual, okay, I'm going to type, it seems like the market was down while some individual stocks were doing okay. And so if I can ask you, when you're talking about individual stocks, what do you, like what ones? What ones, and yeah, and okay. It's kind of interesting. A couple of you just typed in there. So yeah, I mean, as a whole, and I agree. I mean, it's one of our core holdings, right? As a whole, Apple fell from 179 to 157. So I might disagree with that one, as it seems like it was doing okay. Yeah, let's go. Let's try Bank of America. You know, I would disagree with that one. April 43 down to 36. So Bank of America was also technically not a real good one. What else? Don't say Boeing, man. Bank of America's at the bottom there. Facebook, there we go. Which is funny because we just said it wasn't too bad, but Facebook went from 238 down to 169. We're back up to 211. So 236 to 211, down 10%. But yes, Jim, we actually made money on Facebook through April. No, Ford won't be in there either. And no, JP Morgan will not be in there either. Visa. I think you got something there on Visa. Visa was at 225. It's at 211, so it's down about 14, having a hard time staying above the 200 day. So I like where you guys are going with it, because in all reality, yes, it seems like the market was down while some individual stocks are doing okay. In all honesty, that's not true. That's not true. In fact, not to scare you, but I love this article. I put it in here because I thought it was pretty impressive. And it really is just comes down to this. Where am I at? So here's what it really comes down to. The Nasdaq had its worst month since 2008. The S&P 500 was down 8.8% for the month. And yes, it's the worst month since 2020. And then when you go back to like 2010. So in just a roundabout, semi-simple way to say it, on one of the 3 or 2 major indexes, we had a 2008 like scenario, and on the S&P 500 we had the worst month since the bear market correction, which is down down 20%, right? And 2020. To give you an idea, that's how bad last month was. Worst month since 2008 on the Nasdaq. Worst month since our February, March 2010, 20% pullback. It was bad. Bill, I'll keep that between you and me. So here's where I'm going to go, because primarily we call our trade, right? So this is why we call our trade. And I'm just going to throw some of this out there because I know some of you are like, geez, Kevin, this is getting so freaking old. But here's a couple questions. Can you stay solvent longer than the market can stay irrational? So what do you think? Can you stay solvent longer than the market can stay irrational? In all honesty, my risk tolerance says, hell no, I can't. And there is a point where we could see our market lose 65% this year. I'm not saying it's going to happen. I'm not planning on having it happen. But there is a case that we could lose 65% this year. We've lost, what, 15 and a half already. And then I got to go back to the basics. Because I'll be honest with you, and I can just say, I can be honest with you. I have been worried when our stocks don't bounce back in a timely manner. So let's go down to the ability of the collar trade. You guys tell me, what are the benefits of collar trading? What are the benefits, or at least having protective puts? I like it. We make up some of the downward movement. That helps us stay solvent longer, right? I like that one. Make money with the puts that Hurley Investments then uses to buy more shares for a quicker bounce back higher. I agree. I can go that way, Bill. I'll do it. Protection when other things are going against the market. And if I can go ahead and just mention those other things, we will have everything. Oh, spell, Kevin. Everything protected tomorrow for the rate hike announcement on Wednesday. And then, guys, on Thursday, I turn 50. Half of my life is over. I'm going to take a long weekend, and Kiev is going to take over Thursday and Friday. And my wife's going to go take me somewhere, and I'm going to hide out for Thursday, Friday, Saturday, Sunday. I'm going to try to come back Monday morning. But yes, just like most of you, there are times I just keep wanting to run away. And yes, Bill, I plan on living to 100. My life is halfway over minus the 9 months in my mother's womb. So let me go through some positive thoughts. And this is where I hope this resonates for you guys. And I'm just going to put my thoughts for the month of April and this year. I'm pissed off. Some things should have come back. I hate inflation. And I hate the current administration's policies. And again, I'm not trying to be negative, but man, let's face it. If the first thing we do to Russia is cut off their pipeline, why the hell did we cut off the Keystone 2 pipeline in our own country? I just, man, someone feed that guy a bullet. I have experience knowing that if I keep making up money to the downside, when the market turns, I will kill it as the market runs bullish. And we already this year we had 5 to like 9% up days. We've had a couple days this year, ginormous up days. And of course, then they came all back down the next day. But the principle is in place. The story of a dollar. If your dollar loses 50% and gains 50%, you have a 0% return. But you also only have 75 cents on every dollar you invested. Caller or protective put trading. Makes up something to the downside, and when stocks lose half their value, I have twice as many shares making money as the stock bounces back. And that's what I live on. That's what I live on. That's what I look at portfolios. I had someone ask me, because I understand some of you are worried. Some of you are frustrated, right? I get it. We're there. In fact, Keeves only told me probably a half a dozen times, for crying out loud, Kevin, we're taking a bit of a beating. Being down 10% is not being down 15, but adding the shares, I agree. I had someone ask me, man, what about that 60-40 portfolio? And I found a very interesting article, not written by me, but about how this 40-60 portfolio returns and the money that's in it. So without kicking a dead horse, on an up year, a 60-40 portfolio rarely, if ever, especially the last since 2008, with low yields, if 40% of your portfolio is making only 1 to 2.5%, you're not going to beat the market. In 2020, when you get like a 43%, if over a 30-year portfolio is locked into a low interest rate, bond of some kind, you can't come anywhere close to the S&P 500 that only has 60% in equities. It just doesn't work. which is why, guys, as I've been up here talking to you, you know what? It's so easy for education, for commentary, to go back and tell you what's happened and how you should have made money. Anyone here listen to Cramer? Anyone here listen to Jim Cramer? He's probably one of the most popular analysts that's out there that actually talks. Mark and Bill, I love it. That actually tries to be educational for people. I have an integrity issue. When I talk to you, it's like, you know what? My belief is this, but I'm still playing both sides of the fence. My belief is we're going to have a serious washout on Wednesday when we take a 0.5 percentage point or possibly even 75 basis points for a rate increase on our interest rates on the FOMC rate decision. I make those comments on what I believe. You know what I don't tell people? You should go put all your money into it. You should go all in. You should do this. Do you realize on March 28th, good old Cramer made the comment, you know what? You guys all, bear market's over. Bear market's over. Market's only down like 5%. On March 28th, last day of March, we're good to go. Nothing to worry about. Well, let's just take one look at our markets, right? Dow Jones went from being above the 200 at pretty close to 35.4K, staying down to 33,061, down 10%-ish roughly on the Dow. S&P 4,600 down to 4155. We know that was 8.8. Nasdaq 14,600 down to 12,532. Wow, that was supposed to be like 13%. I don't see it, right? I don't see it. What I do see that's rather important, we have a rate decision on Wednesday. It would not surprise me Wednesday through the rest of the week to see what we call a washout. In fact, I even have an article about it down here. A washout on how they call it a flush out. I call it a washout. Let's call it a flush out, where we could most likely lose another 5 to 8 or 9%, which would drop our markets down to 20 to 24% down on the S&P 500. And then we'll start seeing the market pick up because it's considered cheap again. It's for whatever reason, if we go down 20 to 24%, we'll probably recoup 2/3 of that back up in the next 1 to 3 months. In fact, I've got an article in here on how someone expects like a 10% rebound here in May. But don't be surprised to see the market fall out on Wednesday if we have a 0.5 point, or if they're dumb enough to run 2/3 of a point of a market flush. This week, average work week, probably going to be worse than we've had in a while. And I wrote this one wrong, unit labor costs. But we have construction spending, which was worse than expected. That came in at only 0.1 instead of 0.8. Our ISM manufacturing, anything above 50 is growth. We're supposed to have a 57.9, came in at a 55.4. 2.5 points lower, but still an expansion. ADP, we're supposed to have 390,000 new jobs. Trade balance, we're going to be upside down by almost $100 billion. The MBA, a lot of housing is not going through right now. It's become really expensive really quick, and it's really going to be even worse coming up. Consumer credit. I'm going to go through consumer credit on Friday. I'm going to go right here. Look at how consumer credit, which is only supposed to be like 9 billion, skyrocketed in February. Consensus thought it was supposed to be 15.5. It just took off. Consumer credit, people are spending more money. I don't know if it's the hangover, but this is why we're staying in Block. This is why we're staying in Visa. This is why Bank of America and JP Morgan will do well in a higher interest rate environment. It's really important for me to see the consumer, who is our GDP. Well, Kevin, last month, it's like, of course, we're going to have historically, bad GDP numbers in April. If we're all paying taxes instead of paying for crap we want at the store, and our taxes were higher this year because our child tax credits got paid to us ahead of time, we should have a negative print for GDP in April. We should almost have it every year. We tighten up, we save a little bit of money, we pay our taxes. It's not surprising. I don't think we're going in the recession because we paid our freaking taxes. I'm going to pay attention to consumer spending. I'm going to pay attention to personal spending and personal income. I'm going to see if we're going to push through, and if people, since we've been locked inside, haven't taken enough advantage of Amazon like they should. We don't right now look like we're in a recession. But if we keep doing what we're doing with our interest rates, we got to consider it. All right, where are we going here? More information. I'm just trying to give you guys information so you get an understanding or wrap your head around what's happening. S&P was down more than 9% over the last 4 weeks. I mean, we really are hitting some horrific numbers. We just don't have the media that's describing it like it was in 2008, 2010, 2020, with the S&P down like a stealth 10%. Good news to a certain degree, we're getting down technically to where we're going to get overbought, or excuse me, oversold. We're going to get oversold on a technical level. Let me go to the S&P. We're going to get oversold. It would not surprise me on the rate to see us get right down there on that S1 support level of 39.72. That would be my number, 39.70 That would be my number that it would not surprise me to see that at the end of this week. That's why, even though we have nothing on banks right now, nothing on Visa right now, nothing on Facebook, we will be protecting for our interest rate hike meeting on Wednesday. If we get down to that level, there's your more than 20% in 5 weeks, and you'll start to see our markets drift higher over a 1 to 3 month period of time. Big money's been out most of last month. I'm really waiting to see this oversold. It'll look something like this, where we can go from 42.22 up to 45.95. The article that I have with that 10% increase in May, the guy's not a genius. He's just saying, hey, you know what? From the lows to the highs, we did that in January. From the lows to the highs, we did it in March. Why couldn't we do it again in May? Kind of makes sense, right? Nothing spectacular, nothing earth-shattering. Could we have a rally in May? We could, especially if we could get down to that 3970-ish level on the S&P 500. Nasdaq, you can't look much worse. But yes, could we lose another 1,000 points? What is that? 4.6% roughly down to that S1 support level? Certainly. We really could. And then again, we'd expect to see 10% bounce back, 15% bounce back, almost 16. Expect it. I mean, it's just simple technical analysis, and our catalysts are higher interest rates. Higher interest rates, and that's what we're up against. Hey, really quickly, was I a little bit choppy on that? For some reason, was I choppy? You guys all able to hear me okay? Go ahead and let me know if I've been okay, if you've heard me okay here. All right, perfect, good. Kiev might be your family there. All right, so again, nothing spectacular. We're just looking at technical analysis. Another 4 to 5% down, another bounce higher. Where are we in May? Right now, I'm not sold that we're going to have our 10% bounce back. I'm still following the trend, but over 9% on the S&P in April, I think we'll start a little bit of a slowdown. Earnings this week, we've got quite a bit of earnings coming up. We'll be paying attention to Block on Thursday. I'm going to pay attention to Monster Drinks on Thursday. Under Armour on Friday before the market opens. Starbucks after the market closes. British Petroleum on Tuesday morning before the market opens. Pfizer before the market opens on Tuesday. Johnson Controls on Wednesday. Cheniere Energy on Wednesday. Who's here? Let me see. Kohler. Don't forget Chesapeake on Wednesday afternoon. So Wednesday we might be having a quick call. I was out in Kansas City and I ate dinner with the Chesapeake upper up manager, regional manager, or regional vice president, I think is what he called himself. Little information I want to get into your hands on Wednesday based on their earnings, and just a thought for you. Economic reports, construction spending, ISM manufacturing index today, factory orders and jolts, how many jobs we have available for people, ADP employment, but the FOMC rate decision will probably keep our markets flat tomorrow and probably will start the downtrend on Wednesday afternoon, especially if you see a big rush down. It's not something you trade. You don't trade Wednesday. You work your way through Wednesday, Thursday, Friday. Remember, 1, 2, 3 days is not a trend. Friday, average work week. not the no farm payroll. That should be the non-farm payroll. Private payrolls, hourly earnings. I mean, we're just going to see what shape our economy is in. Buffett bought more Apple. He had a great weekend. The weekend I was listening to Buffett's investment conference, pretty darn interesting. A little bit on why Buffett doesn't believe in Bitcoin. And again, it's just that there's no value. Munger, the last paragraph, pretty interesting. And this is from Munger, right? In my life, I try to avoid things that are stupid and evil and make me look bad in comparison to somebody. And Bitcoin does all three, Munger says. In the first place, it's stupid because it's likely to go to zero. It's evil because it undermines the Federal Reserve System. And third, it makes us look foolish compared to the communist leader in China. He was smart enough to ban Bitcoin in China. Pretty interesting idea through a thought from some of the best investors I've ever seen. Jim, yes, and they're also a little cash low. So again, I'm going to give you a call Wednesday afternoon, just as a heads up. Disney, I like to see Disney is getting people out. People are getting fired. I think one of the best things for Disney to happen is to Bob Chapek to be gone. If you really want to see Disney move $30, $40, $50 quickly, fire the CEO for the poor job he's done, where they've lost 25, 38% of their business in the last 6 months. In regards to nothing related to their earnings, their growth, time to look for a new leader. Stock market flush, make sure you read through this one. And then Jim Craner's oops. Hey, we're all good. We're all going to make money. Everyone needs to pile in. I really enjoyed seeing him being wrong and wishing more people would use their own common sense than just blindly follow someone. So with that said, what questions do you guys have that I can make my best attempt to answer? What questions do you guys have that I can make my best attempt to answer for you? And Bill, I don't know if they'll go all the way to Chapex, but I'm ready for the Iger round 3. Bring them back for a third time. He ran the company the way it needed to be. So, Peter, so yes, so you're rather new. Caller trading is admitting that I'm not exactly sure where the market's going to go. So I'm doing nothing more than changing my odds to my favor, right? Stocks move up, down, and sideways, which means you have a 1 out of 3 chance or a 33% chance of making money. If you're a straight options player, that actually drops down to a 20% because of time decay, theta, the 5 components of option pricing. You have a 1 out of 5 chance. So by caller trading or protective puts to act like insurance, you now have a position that goes up if it goes up, a position that goes down if it goes down. You have a 2 out of 3 chance of making money in some direction, right? Now, this does not mean your account will not go down. In fact, you've got to be common sense, but the idea is it doesn't go down as much as the stocks are going down. We're trading individual stocks so we can have one that pop and will beat the market. You're going to add more shares as it goes down. So Peter, it's just a matter of saying, hey, we're changing those odds into our favor. It's when it goes sideways that we see a big loss usually. All right, so what else do we have here? Tony, yes, I would not be putting a new position on or looking at new positions until Monday. So for our trade findings and adjustments, if you're putting on a new position right after a historical, hasn't happened since the 80s, 50 basis point move, I've got to question why you would be trading in such volatility. Mark made the comment, will a 10-year Treasury yield above the 3% cause a prolonged sell-off in stocks? I don't think so. And Mark, the reason why is you had a 26.5% return last year. How many people are going to run to a 3% return when they just made 8 2/3 that in a single year? Really, for most bonds, even at a 3%, that's their break even when you go to management fees and cost. It's, yeah, when you redeem those bonds and get your coupon rate back to you, not your coupon rate, the par value back to you, that's when you see a lot of the fees. And I mean, I guess each to their own, but when last year you had 8 2/3 the opportunity to make more than a 3% bond, I don't see where the interesting part is of that. So it depends. Really, bonds do much better at about a 5% return. Russ Kramer made the comment, puts are great for a trending down market, but a sideways market, yes. If your stocks are moving sideways, puts can get expensive. If you're going to spend somewhere between 4.5 to upwards to maybe 7% of the value of your stock on puts when it's trending sideways, definitely your protection gets expensive. Agreed. To be using puts on that option, you're looking for some volatility. You're looking for some big movements in your stock positions. Not a good, let's face it, Clorox, consumer essentials, not discretionary, consumer staples, excuse me. Boring stocks. Those are not the one to call or trade because they just don't move and they cost too much. Are there any other questions? You guys are doing good today. If I don't see any more come in, guys, I appreciate you being here. Again, it's really easy to look back and see what you could have done. No, I'm not changing anything. I've been through this too many times. I've been through a 2008. We even had one year this year where, again, most people are in that 5 to 7.9% up in a single day. We're set for our rebound. We just need our rebound, and it will probably come, especially when you see a 20% sell-off on the S&P when you go into correction territory, bear market. Actually, it's a bear market. When you lose 20% or more, that's when you start to see a cheap market and people buy back in. All right, hey, I don't see anyone else joining us, guys. I appreciate you being here. I will do everything I can to see if we can't get this posted tonight or first thing tomorrow. Definitely spend your time looking it over. Spend your time getting this information into your systems so you can learn and understand what the market's doing and why. You're not always going to be right, but it'll help you make your best educated decision. And I think it also will help calm you down when the markets are just doing stupid things. Guys, good being with you today. You guys have a great time, and I'll look forward to seeing you next Monday. Keeve will have this Thursday, and I'm thankful for Keeve. As I said, yes, I'm going to hit my halfway life mark. I'll be 50 on Thursday, so I've got another 50 years to go. Guys, take care. Have a good evening, and I'll see you next Monday. Bye-bye.